What if I told you that the age often remembered for glittering mansions, grand railroads, and unimaginable fortunes was also one of the most corrupt, unequal, and ruthless chapters in Wall Street's history? The Gilded Age, spanning roughly from the 1870s to the early 1900s, was a time when America appeared golden on the surface but rotten beneath. Coined by Mark Twain. The term gilded implied a thin layer of gold covering deep structural flaws: political corruption, monopolistic power, financial manipulation, and staggering inequality. Nowhere were these contradictions more visible than on Wall Street. As the United States surged into industrial dominance, Wall Street transformed from a chaotic trading hub into the command center of global finance. Money flowed faster than ever before. Fortunes were built in months instead of lifetimes, and a new class of Tycoons, financiers, and industrial barons rose to power, shaping markets, governments, and the lives of millions. The engines driving this transformation were railroads, steel, oil, banking, and electricity. Wall Street became the bridge between industrial ambition and financial capital. Men like Cornelius Vanderbilt, John D. Rockefeller, Andrew Carnegie, J.P. Morgan, and Jay Gould were not merely businessmen. They were architects of a new economic order. Vanderbilt consolidated railroads with ruthless efficiency, understanding that control, not competition, was the path to dominance. Rockefeller built Standard Oil into a near-total monopoly through aggressive pricing, secret railroad rebates, and vertical integration. Carnegie changed the game in steel production, while Morgan mastered finance itself, merging companies and keeping markets steady, and wielding influence so vast that governments often deferred to him. These men were hailed as true icons of the American dream and success. Their methods walked a fine line between smart and shady. Wall Street values bold moves over fairness, and the rules of the game were often written by those with the most capital. As capital concentrated, Wall Street's power expanded beyond markets into politics. Lobbyists, bribery, and backroom deals became standard tools of influence. Stock manipulation was rampant. Insider information flowed freely, and pools of financiers secretly coordinated trades to inflate or crash prices for profit. Jay Gould, infamous for his role in the gold ring of 1869, attempted to corner the gold market by exploiting political connections, nearly destabilizing the U.S. economy. The resulting crash, known as Black Friday, revealed how deeply Wall Street's interests were intertwined with government officials. Ordinary investors were left devastated, while the architects of the scheme largely escaped punishment. These events revealed a harsh truth. During the Gilded Age, financial power often outweighed legal accountability. Yet, despite the corruption, Wall Street also became a machine of growth. Capital financed factories, bridges, skyscrapers, and rail lines that transformed America into an industrial giant. Immigration surged as millions arrived seeking opportunity, fueling labor forces that powered industry but often endured brutal conditions. The stock market became a symbol of aspiration for the middle class, even as the risks remained poorly understood. Newspapers breathlessly reported market movements, magnifying both excitement and panic. Wall Street turned into way more than just a street. It became a national obsession, a theater where ambition, fear, and hope collided daily. As wealth accumulated at the top, inequality widened dramatically, setting the stage for social unrest and future reform. The rising action of the Gilded Age was defined by expansion without restraint, progress without protection, and power without oversight. The conflict at the heart of the Gilded Age was unavoidable. As monopolies tightened their grip and Wall Street's influence grew unchecked, public outrage began to boil. Workers organized strikes, farmers protested railroad pricing, and journalists known as muckrakers exposed corruption and exploitation in vivid detail. Financial crises laid bare the system's fragility. The Panic of 1873, triggered by railroad overinvestment and banking failures, plunged the nation into a deep depression. Businesses collapsed, unemployment soared, and confidence in Wall Street evaporated. Once again, speculation revealed its destructive side, and the public began questioning whether unchecked financial power was compatible with democracy. Wall Street's titans, once celebrated, increasingly became symbols of greed and imbalance. Even with all the craziness going on, Wall Street just rolled with it instead of falling apart. J.P. Morgan wasn't just a financier, he was a system stabilizer. During the Panic of 1893 and later the Panic of 1907, Morgan personally organized rescue efforts, coordinating banks and investors to prevent total collapse. In 1907, with no central bank to intervene, Morgan once famously locked a bunch of top bankers in his library until they finally agreed on a rescue plan. His actions stopped a financial disaster and demonstrated both the immense power and the dangerous necessity of private control over public stability. The lesson was clear. Wall Street had grown too important to fail, but also too powerful to remain unregulated. This realization sparked reform. The excesses of the Gilded Age gave rise to the Progressive Era, during which government began asserting oversight over markets. Antitrust laws, like the Sherman Antitrust Act from way back in 1890, were all about breaking up monopolies and keeping the market fair for everyone. Regulations are tightening up to stop the bad stuff. Although enforcement was initially weak, the cultural shift had begun. Wall Street was no longer viewed solely as a source of prosperity, but as a force requiring accountability. The establishment of the Federal Reserve System in 1913, directly influenced by lessons from the Gilded Age and the Panic of 1907, fundamentally reshaped American finance by introducing centralized monetary control. This marked a turning point. The era of unchecked financial empires was giving way to a more structured system. The payoff of the Gilded Age is complex and enduring. It left behind staggering wealth, industrial might, and a financial infrastructure that positioned the United States as a global power. At the same time, it exposed the dangers of concentration, corruption, speculation, lessons that continue to echo through every modern financial crisis. Wall Street came out of the Gilded Age stronger, but changed forever by the need for more transparency and rules. The big players back then really laid the groundwork for how we handle money today, even as their excesses forced society to confront the cost of unchecked ambition. In the end, the Gilded Age was not just a chapter of greed or greatness, it was the crucible in which modern Wall Street was forged, proving that money and power, when left unbalanced, can shape history as dramatically as any war or revolution. The Gilded Age, covering the 1870s through the early 1900s, was a paradoxical era of dazzling wealth and deep corruption on Wall Street. Tycoons like Vanderbilt, Rockefeller, Carnegie, Morgan, and Gould amassed fortunes through ruthless monopolies, stock manipulation, and political influence, transforming Wall Street into a powerful engine of industrial growth while exposing the vulnerabilities of unregulated finance. Ultimately, the Gilded Age forged modern Wall Street, leaving a legacy of industrial might, wealth, and enduring lessons about the balance between ambition, regulation, and accountability.